Morning, Chris.
Hey, good morning, Brian. How are you?
I'm great. This is Brian Jones. I'm here with Chris Hood, professional trader, world's most interesting man, the
Wearing
Canadian.
my official summer shirt, which is stay calm. We're going to go grill meat outside.
Yeah, the South African Canadian options guru.
It's the South Afrinadian.
South Afrinadian. I've not heard
Yeah.
that. That's
Or a Can-African.
which is the PC term these days?
And then there's no politically correct term for some white dude from South Africa. I mean, we're like bottom of the list, man. I get called "Hey you." It's like, that's probably the most correct term is "Hey you," but we could get a little bit expletive. You know.
Well,
Are you watching the Olympics?
I just a little bit. I'll catch a little bit of it. I haven't sat down to watch.
Man, it's impressive. Man. These guys are superb athletes.
Yeah, it always impresses me how much. I mean, when you look at them compared to each other, you look at them and they're so close, and then you realize that any one of those people would destroy any other person in that sport.
The one thing that was disappointing was judo. I was really looking forward to watching it, and it was so viewer unfriendly. I think, and then I went and looked at how the rules have changed over the years, and they've eliminated so much of the spectator-friendly techniques over the last couple of decades that it's really not fun to watch at all.
The highlights are great. I like to watch the highlight videos because they show the big throws, like when someone's really outmatched or really tired and they get nailed with something beautiful. But most of the time it's this people grab and then they fall down, and it's it comes down to just some minor score.
I don't like it. I found it a little bit boring. I did enjoy watching the wrestling. So I enjoyed watching the wrestling and the women's volleyball. Man, these women in the volleyball team, the one woman was as tall as the net. I was like, she literally could look over the net. I was like, this is unbelievable. She must have been 6'8" or something. It was crazy. Anyway, really I really enjoy it. I think it's cool for sport to see it. But I don't like this political angle that they've put into it. There's some athletes that have got this, hormonal thing that makes them a little stronger than others. And then you've got some that identify themselves as others and they're competing against.
I don't even want to get into that.
I'm like, when it comes to strength and combat sports, go and have your own division. We won't get into it.
Exactly.
Well, I'll get hate mail for it, I'm sure.
At the risk of alienating some viewers. Okay, so what about what about the market in general right now?
Well, earnings season, right? So we had Google come out with that phenomenal pop-up at the open. I mean, a lot of our clients made some pretty nice dineros on that one. Amazon was the disappointment, and I've got to be honest, I took a lot of pain last Friday. I did a trade on Amazon hoping it would do what it normally does, and it didn't. So it took a bit of I took a bit of a painful experience on Friday. But Amazon tends to be one of those stocks, right? It tends to sell off after earnings. So Bezos lost his title as world's richest man on Friday because I think he lost $14 billion in one day, which for him is nothing really. And you've just got to wait for these charts to repair themselves. There was a lot of technical damage on Amazon. Does this set up a reversion to the mean? Possibly. I think you've got to be patient though, because once the selling stops, because he tends to sell his shares after earnings to fund his rockets or whatever he wants to do, you've just got to be patient. I think that there's going to be some trades now on Amazon coming up. One thing that's really surprising me at the moment is Tesla. So Tesla is not my favorite stock to trade. It's always tended to invite me out for dinner and then leave me stranded on the side of the highway kind of thing. But it's got some merits at the moment to be, to see if we can get up to the 750 level. markets in general, we're not going to have the Fed coming out in the next week or so. We're not going to see them for a few weeks. They're all going to Wyoming to go and have their powwow and make sure that they say the right things. There was this comment yesterday by one of the chuckleheads saying that they might start tapering off the bond purchases if employment numbers start to increase. They've said that for the last couple of months, so it's nothing new. I think in earnings season, you do have to trade earnings with a little bit of a gambler's mindset, right? You don't really know. Expectations for earnings at the moment are quite low, so a lot of companies are overshooting, but yet, even though they overshoot on earnings, the stock prices get sold off. So, I would say to any beginner, just don't trade earnings, just wait for it to happen and then get into the trade afterwards. It's like going and playing roulette and throwing your money on the wrong color. It's too easy to get it wrong. So Friday was a tough one for me with Amazon, but you can't win them all, right?
No, I mean, that would be nice if you could win them all.
It would be, but it would be unrealistic at some point, because your win rate has to drop off. And a lot of beginners get into trading expecting to have a clean sheet. It's like trying to get into the Major League Baseball and thinking you're never going to get struck out. It's never going to happen. You are going to get struck out at some time. It's just how frequently do you get struck out and under what conditions you get struck out. So I think for earnings season does tend to blow up a few accounts. A lot of retail guys tend to overload their boat and get the directional bias wrong and trade to the wrong side. This is definitely not a market I would be shorting. It's shorting is a science to itself, because calling a top in an upward trending market is incredibly difficult. So just because something hits a new high doesn't mean it's going to come down. If anything, it's going to go the other way. Stocks that make highs tend to carry on making highs, right? They tend to do that. I heard it from a very good trader a couple of days ago. There's nothing more bullish than a new high, and that's good advice. Just don't try and short things. I'm not short at all. In fact, when I short stuff, I tend to just do call spreads. I do credit call spreads on the indexes. Because if I'm wrong, it's not going to be a painful burn. If I'm right, I get a nice little bit of income. So I don't really want to be trading directionally to the downside just yet. I think the signs are still that the market is trending up. So, stick to that bias.
So August and September are, seasonally bad months to trade.
They are difficult. Yeah.
Or, I mean, let's say they're seasonally down, I guess, or volatile.
Seasonality, you can't drive your car looking in the rearview mirror. So it becomes really hard using seasonality as the guide to your future trades, right? Because at some point, if you're only watching behind you, you're going to hit a tree. You will do that. What it does do, though, is it provides context. So I usually look at seasonality as context for movements. If the seasonality is that this type of this sort of period we're in is bearish, or that the possibility of upside is low, then just trade a little bit differently. Size your positions a little smaller. It doesn't mean you don't trade. Like I don't believe in the sort of jump out of the pool completely kind of thing. The reason being, I still have bills to pay. And if I'm not in the market, I'm not making anything for those bills, right? So what you've got to do is you've just got to size a little differently. Make sure that you understand context overall. So if we are in August and, all the hedge fund guys from New York are in the Hamptons on their boats and stuff, well, the liquidity is going to dry up. It doesn't mean the trade doesn't exist. It just means the liquidity is not there. Now, remember, when liquidity is low, being right, if you're right on the direction of a trade and liquidity is low, that's your best friend. But if you're wrong, it's your worst enemy, right? So you've just got to be careful on where you sit in terms of those trades. So if you do want to trade, lift it up a little bit. Don't go for the individual stocks. Move up into the ETFs, the sectors, and the indexes. Rather trade the things that are going to be bigger, more liquid, a little easier to trade than, you know, some small biotech stock that's got 3 people a day buying shares. Like, that's where you want to avoid those ones and stick with the ones that have got more liquidity. So it just means you trade differently. That's all it does. It doesn't mean you don't trade. It just trade differently.
Well, I know that there's a lot of, you're doing a lot of sort of calls and bull call spreads now because the volatility is kind of, there's not a lot of volatility in the market.
Yeah.
On
So,
a lot of stocks.
so what you do is in markets like this, when it's strongly trending to the upside, trades that benefit from volatility expansion tend to work better. So leading up into earnings, you know, buying an out of the money call spread, you know, on a stock that's got the potential to outperform earnings or have a greater than the expected move kind of reaction, you want to be buying cheap call spreads that will expand in value as we get closer to the event. You know, selling put spreads prior to earnings is not necessarily a good idea because those don't benefit from volatility expansion. They benefit from volatility decreasing. So, yeah, you just got to choose the horse for the course, right? You know, a lot of times individual retail, you know, beginners, what they do is they tend to get married to a particular strategy. So it's like, I only do naked puts, and, you know, this is the strategy that I use. And then they go off and do it without recognizing how the market conditions have shifted, making naked puts more dangerous than before. So all the winnings that you make up to this point, you then give away because you've now been assigned on stocks that have dropped. You know, it brings into question, you know, a lot of retail guys use the wheel strategy, right? So sell puts, get assigned, sell calls, get assigned. You know, they do this thing just over and over and over. And I think, you know, you've got to look at it from the perspective of market condition. That works really well as long as the stock doesn't fall down too far. That's the problem that you have with assignments on short puts. It's about the stock falling too far away from your entry price, making selling calls dangerous because now you're going to be assigned underneath your purchase price. So you're going to materialize a loss on assignment. Or, you know, it's quite complex. But yet, often what happens with a lot of retail guys is that they will get sucked into the seduction part of a trade strategy. Look at this, you know, you're selling puts on stocks you want to own. Wouldn't it be great to own, you know, GE at 30? You know, I remember the days when it used to trade at $30, right? And then it dropped. And now they've done a reverse consolidation. So the stock price is a lot higher, but, you know, it went up to 30 and then it dropped down to 10. If you'd been assigned at 30, you would never have been able to make your money back by selling the $30 call because the stock was trading at 10. So there was no premium up there. And that's the biggest risk that you run when you have to take assignment on a short put, is that can you recover the loss by selling puts, or sorry, by selling calls at your original strike price of entry? Or are you going to have to adjust it and sell it below your strike price? Then you have the risk of assignment. Now you get assigned at a lower price than what you paid, you materialize a loss. How many of those can you really afford to take? So I'm always a little circumspect when I read the sales pitches of certain strategies because it's often never telling people about the worst case scenario. All right. The worst case scenario on a naked put is you get assigned a stock that drops to zero, but it doesn't need to drop to zero for you to lose. It might have to drop only 15%, maybe 20%. What if it has a great earnings report like Amazon? Imagine if you had sold naked puts on Amazon at 3,000, whatever it is, and it drops down $200. And now you get assigned, and Amazon sits there and consolidates for the next 6 months. Are you willing to take the risk of selling an in-the-money call on your strike to take a loss just to get some small little premium? I don't know. I don't know. I think that's not a sustainable way of doing business. In terms of buying something for 10, selling it for 6 and doing it over and over again. That doesn't make sense to me. But I'm happy to be convinced. So if anyone out there is doing this, you know, feel free to send me an email and tell me how you're doing it, because I just don't see how the math works out, particularly if the market changes direction. In an upward market, I get it. I can understand it. Upward trending market, pretty easy to do. But if you have no way of determining when that shift happens, and you get lumped in and assigned, I don't know, man. I'd have a hard conversation with my family to tell them that I'm now the proud owner of stocks that are worth a third of what I paid. That wouldn't be good. That wouldn't be good. No,
not at all.
no.
Not at all. So
I think trading directionally in these markets is a little easier. It's a little easier. I think that the seduction of credits is misleading. You can be suckered into just doing, credit spread kind of trades all the time in a market that doesn't pay you for it. Like the volatility numbers at the moment on the put side doesn't make sense. Like there's just no risk of downside. When you see volatility numbers the way that they are, the market's not predicting a crash. What you want to be doing is selling puts when they're expensive so that you get paid well. If you're willing to get paid 40% less compared to the guy who's going onto the directional call side and he's getting paid 40% more, he's going to make more money. That's just a matter of choice, right? It's purely a choice that you make. But when I look at put spreads and I look at the risk that people take, I always just shake my head. I'm like, why would I do that? It's an inefficient trade. I'm risking way, way, way too much, and I'm not getting paid for that risk. So
in this particular market, it's just not a good idea.
I wouldn't say it's not. It's just you've got to be selective. It's like put spreads for me are my third strategy. They're not my first strategy. But there are times when put spreads become my first strategy and everything else. It's just knowing when to switch from one to another, to another, to another. Your toolkit cannot be one trade strategy. That's not going to make you successful because you run the risk of losing all the gains that you make by applying the tool at the wrong time. That's the risk that you run. The biggest problem for traders is not making money. It's keeping it. Making money in trading is actually not that hard. If people tell you it's difficult, then they're probably doing it wrong. But, it's keeping the money that you make. Because what happens is it's like a cycle. You make some money, you get excited, you oversize, you lose. Now you're back to zero. And then you do it again. And you keep falling into that mental trap of, adding too much risk at the wrong time. And then losing. And then you go, oh, I'm terrible at this game. And then you've told your brain you're bad. So now you're constantly searching out opportunities to revalidate that you're bad. It's a tough game. This is
it's like a psychological trap.
Oh yeah, a lot of people get caught in it.
So with regard, let's talk a little bit about the directional strategy. So call, bull call spreads. Like when would you do a long call versus a bull call spread? Like what sort of criteria would differentiate the two?
Both of them have the same entry criteria, right? Both of them would have the same entry criteria. So, you've got a stock that's trading. Let's open up a graph and do it that way. I think it's easier to show you in a picture than it is through me trying to, talk it through. So let's have a look at a day chart, right? So let's open this up. Okay, I don't know if that's clear, but let's we'll use this chart. So if I've got let's turn this into Google. Okay, so here's Google. And what we have here is a steady step going higher, right? We have periods of consolidations moving up. Now, what would drive me to buy a credit spread versus, not a credit spread, a debit spread versus a long call here is price, because Google is very expensive. At $2,000 a share, I've got to be prepared to risk quite a lot of money by buying, a call option, a straight long call. So here a call spread would make a lot more sense to keep it within the realm of my risk allocation for Google. If we use the cheaper stock, let's say Goldman Sachs, here I may be able to afford a long call directly rather than a call spread. All right, so at $400, maybe a call is going to cost me less. Let's have a look. Goldman Sachs, if I went and did a directional play. So usually when I decide on direction, I'm going to be looking at the monthly expiry. All right, so 17 days, there's a $20 expected move. That would put this up at around 400. So here's where the market is expecting the stock to be up here at around 400. And you can see that there's some pretty decent volume that's going through here. Now, I don't know if, the people that are doing this are doing, iron condors. I can't tell what strategy is being done. All I can see is that there's a lot of interest here at the 400 mark. Now, to buy that option is going to cost me $180. Whereas with Google, buying the same delta option would probably cost me $1,000 or maybe $2,000, $2,000, $20. Let's have a look at Google. So Google, the same option on the 17th up here at the expected move, which is $100, let's say 2.8, somewhere here, is going to cost me nearly 3 times the price. It's going to cost me around $800. So when you decide what trade strategy you want to use, you have to decide on 2 things. How much am I going to put in, number one, and what am I trying to achieve out of the deal? Because if I buy a long call, my upside is unlimited, all right? That means I would do it on stocks that have got a greater than normal chance of giving me a higher than expected move, all right? So if the expected move is 100 on, let's say on Goldman's, the expected move by August is $19, right? So we've got a $19 expected move. We go over to the Goldman's chart and I look at the squeeze that's been forming. I look at all the factors that sit here in the channel. We've got compression happening in price. We've got a potential breakout of this downward descending channel line. We can, if Goldman's can get above 380, 381, there's a real possibility that Goldman's could then take out that previous high of 393. So that's a $14 move. And yet in 17 days, the market is saying it's only going to move $19. So I'm looking at it going, well, maybe Goldman's is going to go in. It's going to probably face some resistance at these 3 levels here, possibly some resistance here. So we've got 4 levels of resistance to get through. I think that Goldman's can do it. It's a fairly liquid stock. It's got a lot of interest. A lot of people are buying it. Squeeze is there. I would suggest that we could get a better than expected move. So from here, doing a long call option out of the money, a little bit risky. If Goldman's drops a little bit between now and 17 days, that transaction is wiped out. So it's not the safest idea buying this call option. However, going in and buying something lower down, maybe the 60 delta call spread, this one, the 60. So I'm going to buy the 375 and I'm going to sell the 400. This one would probably make a better trade because I'm going to be spending only $834. My max upside is double. So I'm risking 1 for 2. All right. Remember, it's 17 days. I'm not going to hit the lottery here. Goldman's is not going to $1,000. So when it says, oh, you've got unlimited upside, it doesn't really mean that. You're only going to make so much. The stock is only going to go so far. So unlimited upside sounds attractive and is very seductive, but unless the stock goes to $5,000 in 17 days, you're not going to make more than maybe this. The market is already telling you it's going to $400. So why would I expect it to go further than $400? So by doing this, I'm risking 1 for 2. Okay, so that's a big dimension of my trade plan, is how much am I willing to risk and how much am I willing to gain? On this trade, the max spread here is $25, right? The difference between 400 and 375. So I like to go with a 70% max of that spread, that differential, right? $17.50 is what I can sell this for. But I've bought it for $8.34. So if I minus off $8.34, it cost me $9. I've got a maximum potential gain at a 70% of the spread exit of $9.16, which still gives me a 100% return on that spread. So why would I use a call option that potentially could give me a lot more on the upside, but I run the risk in the short term of a swing down in price? That would kill the trade. If I'm holding this call spread, the short call option minimizes that volatility for me in the short run, because I'm only going to risk $800. And there's ways I could play with this trade. I could convert this into a bear call spread if the price drops to possibly get another premium and possibly make some of my money back instead of losing 100%. So there's some options that I have available. I have flexibility to adjust the trade depending on how the stock is moving. So when you start looking at directional plays, long call versus vertical spread, the setup is the same. The setup for me is the same. It's purely down to risk, reward, and price. And if a long call option is cheap, I might just do it. If the spread is cheaper, I will do the spread. So for me, that's how I look at it. I don't have a preference to either one. For me, it's about the outcome at the end of the day. Am I going to get a better outcome using calls? On directional calls, though, when I do long calls, I do those mainly in indexes. So if I'm going to trade XLV or XLK, the healthcare index or the tech index, I'll generally use long calls because it's cheap, and I can build up a position over time. If I'm doing single stocks, I tend to use call spreads more than I'll use long calls. That's how I do it.
That's good stuff. Now, in terms of duration, I know that you were talking about a 17-day one and you do 90 plus days. Like what determines the duration of your trade?
So I look at seasonality now. So I go in and I say, you know what, with the market where it is, extended, possibility of a pullback, you can de-risk the pullback. You can de-risk your positions by doing two things. You can either make them really, really short in duration or really, really long in duration. That's the only way you can do it. So really, really short, I do it over the day. Is there a risk of a 5% pullback today? Probably not. Is there a risk of a 5% pullback over the next month? Probably. I don't know. So in terms of duration, I have one rule. When I do a call spread, I prefer doing 60 days out as far as I can. In fact, 90 days out is probably the most normal trade duration that I will use for a call spread. The problem is I don't hold them for 90 days. I probably hold them for 14 days, right? The only thing that I'm trying to do on a shorter duration one is be in and out of the trade as quickly as possible. Because sometimes when you're holding that longer duration call spread, you may be forced to hold a little longer than normal. You might have to wait a little bit for that movement to happen, for that trade to work. So two different things, I try and sit with a sort of 90-day view, and then I sit with also a 7 to 14-day view. I prefer trading in the short run now, because the quicker I can get my money out of the market with a profit, the better it is for my book. So I don't want to be trading too long term. So I've got a mixture in my book. I've got long-term trend. All right. So when you trade the trend, okay, let's do it like this. So what I want to do is I want to trade this movement, right? So this movement from, let me get my little drawing tool. I really like my little drawing tool. I'm not very good at it, so you have to forgive me a little bit. But my drawing tool, I want to trade this movement first, right? That's the first thing I want to trade. So I'm going to be going out 90 days, maybe 120 days, long call options, 60 delta, those kind of trades. I'm going to be accumulating those. But while I'm doing that trade, it doesn't stop me from trading these movements, right? So those would be separated trades, but all within the same ticker, right? So if I just remove that and we go look at one of the ETFs, right? So if we look at, say, XLP, right? So this is something that I'm building now at the moment, right? So I like the look of consumer staples over the next couple of months. There's a trend that is here, right? There's this trend here. See this movement that's happening. So we're building, sorry, let me just put this on. I'm building a position to take advantage of that movement, okay? Sure, there's the pullback. So this allows me an opportunity to add to that position. And now this trend is starting again, which means all the options that I've been adding here are starting to pay off, right? They're starting to become profitable. Now, as soon as we start breaking out here, we start doing that, I'm going to keep adding to this longer trend. And while I add here, I'm taking profits on all of these positions that I added down here. So that's how you're able to trade long duration trades. This is from March, right? We've been building this since March. So in your book, you should have positions that take a long time to mature, but when they mature, they pay off really well. All right, so this one's a big payer for us. There's also these little trades. These little trades can be very, very profitable. But you've got to time yourself, right? You've got to time this. So whenever there was a pullback on a rising trend stock, whenever there's a pullback to either the 8 EMA, 21, 34, you can have a trade plan that says every time this falls into that category or that level, I'm going to add to my long-term trend. And I'm going to consider the trend broken once this closes below the 34. Once it closes multiple times, like 3-4 times below the 34, the trade is gone. Then you exit all your positions and you move on. The trade didn't work. But if you build at the right time, so most retail traders land up never building at the right time. What they do is they build at the highs. They build up here and then they get kicked out there. They don't build at the lows and then take profits at the highs. But that's just experience and that's just practice, right? You've got to condition yourself to say, look, it's fallen to the 34. Let me use my...
So you really have to be like bright quickly on those short-term trades though, because the theta is going to kill you, right?
Yeah, so if you're nervous about theta in a short duration trade, then trade the credit spread. You can still trade a credit spread as a day trading technique. I do that all the time. What I find is a lot of times, let me just find the charts here. So once you put in your levels, okay, so if you've got your levels, so this is the 34 EMA, I want to add to my positions at the 34 EMA. So this is now an adding opportunity. Most retail guys would be going, no, I don't want to do this because this doesn't look particularly healthy. It's not moving up. Those are the sort of guys that miss out. They'll tend to add here. They'll buy at the top of a range because they look at this and they go, oh, it's been rising. Let me buy now. They don't buy on the dips. They don't buy on the dips. So this is a good place to be adding, XLF. If we look at XLV, similar case. Here is not the time to be adding to your healthcare position. It's a little overextended. I want to be buying it somewhere down here, not up here. That's not cool. XLK, same thing. It's extended. I don't want to be buying it up here. This is too far. I need it down. I need it to be at 148, $6 away. So if you're not getting, the prices, you just got to be patient. What you could do up here is you could be selling, put spreads with strikes down at 146, 145, something like that. At least you're getting something out of the momentum on the trend. But when I get the pullback, I need to know, okay, I've got to move. I've got to do that. That's the trade that I've planned. So, I have my indexes and I have my dailies that I watch, Roku, Facebook, Google, Amazon. That's it. There's no need to watch everything else, right? If I see, XLV looking attractive, and this is pulling back, what you do is you go into your sector and you can look at XLV here. Here's XLV. These are the top 10 stocks in XLV. So if I'm looking to add to XLV, I would be looking to, find the one that's got the strongest relative strength, the best MACD, the most squeezes, the best profile against the moving averages, and I want to trade there. So the one that's really attractive at the moment is Pfizer. And we've been in Pfizer for some time. And when you look at Pfizer as a trade, there's going to be a bit of a breakout move this morning. Funny that I'm saying that on a 15 cents move, but Pfizer, look at that trend. Where would you want to have bought into this trade? We've been in this trade since around here. We held it through this consolidation period, and now it's up this breakout move. I think we're up 100 and something percent, I think, on Pfizer. It's a small trade for us. Yeah, it's 140% up for us. We've got 17 days left on the trade. Now it's a question of, do we take a secondary trade on Pfizer to continue this movement, or do we rather put our money into XLV on a pullback? So now if we look at this one, this is where Pfizer is one of the biggest stocks in the sector. You can see this dotted channel trend line up here. It's sort of riding this trend. We could see this up at 134 pretty quickly. And that was my price target that we already put into it. So when it comes to planning your trades, you can't do this on every stock in the market. You've got to actually start from the top and say, what do I want to trade? And for beginners, I would say go to an index. Just don't try and trade an individual stock. Trade an index. Trade healthcare technology. Trade the ones that are strong, the ones that are moving. How do we know which ones are moving? We go to stock charts and we go to the rotational graph. And what this will tell you, based on your time frame of holding, sorry, not this graph, based on your time frame of holding, you want to know which sectors are moving and which ones aren't. So when we look at this simple tool, this is one of the best tools in the market, as far as I can tell. Bring this to your average holding period. There you go. You want to know what sectors to focus on. You don't want to be focusing on anything in the yellow. You want to be building on the red. You want to build in the blue and take profits in the green. So by the time something hits the red, we want to be starting to build a position. When it gets into blue, we start building a little more, but we know that we're going to be taking profits at some point. When it hits the green, we take our money off the table. That's how we do it. And it's a very, very simple tool to look for, because what I don't want to be doing is building now in XLK. I don't want to be building any more in my technology position until such time as the technology moves into the red, because now I know I'm getting a good price. So I want to make sure I get a good price. So move it into here. Yes, then I'll start trading it. I'll start looking to add on pullbacks. Then when it gets to the blue, I start looking to peel some off, and then I start exiting the whole position up in green.
I found this to be really, really helpful.
This is if I have to say, if there's one tool in the market that is absolutely brilliant, it's this one. So if you don't have it on, in your trading plan, so to speak, it's good to add it in. It's really, really good to add it in, especially if you start reducing down your trading days, right? You can see exactly where things are moving from and where they're going to. What's next? Well, energy. This is where you want to be looking now for the next opportunities, is look at energy. Most people won't look at energy because it looks horrible. If you go look at XLE, it doesn't look particularly good right now. And it's probably not good for an entry at this point here. What I'm looking for is a little bit more squeeze. I'm looking for a slightly higher Bollinger percentage. I'm looking for a few more things to give me the clues. But I know that that's something I want to watch. So when I get the clues, I've been waiting for it, I start acting. And then you start building the trades.
Great info as always. Chris,
awesome, man.
About 1 minute to the bell. So guys, click like and subscribe, throw us a comment, go over to Rogue Investing /alpha and check out Chris's paycheck trade product. We got some new things coming up over there at Rogue Investing. So Chris, have an awesome day, man.
Thank you. I will see you next week.
Yeah, absolutely. Same time.
Take care, my friend.
Take care.
Cheers, Ben.